Did you know that market analysis can help you increase your returns by 10, 20, or even 50%? In this video, I'll show you how to analyze stocks like a pro and make smarter investment decisions. Hey everyone, welcome to part 1 of our video series on market analysis. Today, we're diving into technical analysis, a fancy term for predicting where stock prices might go using charts and graphs. Whether you're a beginner or a more advanced trader, stick around because we're going to break it down in simple terms. But before we go deeper, hit that like button and subscribe for more useful tips. It's totally free and helps us keep creating content for you. All right, let's get started. So what is technical analysis and why does it matter? Technical analysis is like reading the story of a stock through its price movements. It's important because it helps us make smarter trading decisions by spotting patterns and trends. It helps us figure out the best times to buy or sell stocks. It shows us if the market is going up, down, or sideways. It pinpoints levels where stock prices tend to bounce up or break down. It tells us how fast or slow prices are changing. It helps us manage the risks of trading and aim for rewards. It lets us test and improve our trading strategies. Pretty cool, right? Let's keep going. To do technical analysis, we need to use charts and tools that can help us visualize and analyze the price movements of stocks. We can use a tool like TradingView to access and customize these charts. For example, here is a chart of Apple's stock price for the last years. We can see that the price has been going up and down, forming peaks and troughs. These are called highs and lows, and they indicate the supply and demand of the stock. We can also see that the price has been following a general direction, either up, down, or sideways. This is called the trend, and it indicates the momentum of the stock. We can use different types of charts to display the price data, such as line charts, bar charts, candlestick charts, and many more. Each type of chart has its own advantages and disadvantages, depending on the level of detail and information we want to see. For example, a line chart shows only the closing price of each period, while a candlestick chart shows the opening, closing, high, and low prices of each period. A candlestick chart can also show the color of the candle, which indicates whether the price went up or down during that period. We will stick with the most common one, the candlestick chart. It shows everything we need to confirm or deny a trade in a more detail. We can also use different time frames to view the price data, such as minutes, hours, days, weeks, or months. Each time frame shows a different perspective of the price movements, depending on the trading style and goals we have. For example, a day trader might use a 5-minute chart to look for short-term opportunities, while a swing trader might use a daily chart to look for medium-term trends. We can also use various tools and indicators to enhance our analysis and interpretation of the charts. These tools and indicators are mathematical formulas or algorithms that are applied to the price data to generate additional information and signals. For example, we can use trend lines, which are straight lines that connect the highs or lows of the price to show the direction and angle of the trend. Moving averages, which are lines that show the average price over a period of time to smooth out the price fluctuations and show the support and resistance levels. Candlestick patterns, which are combinations of one or more candles that show the price action and the sentiment of the market to indicate possible reversals or continuations of the trend. Indicators, which are graphical or numerical representations of the strength, direction, and volatility of the price movements to measure various aspects of the market, such as momentum, trend, volume, or oscillation. There are many types of tools and indicators available, and each one has its own purpose, logic, and parameters. We can use them individually or in combination, depending on our preference and objective. However, we should not rely on them blindly, as they are not infallible or magic. We should always use them with caution and common sense, and test them before applying them to our real trades. Now that we know what technical analysis is and how to use charts and tools for it, let's see how we can apply it to our trading. Here are some steps we can follow to do technical analysis and make trading decisions. Step 1. Choose a stock and a time frame that suit your trading style and goals. If you want to trade Apple on a daily basis, you might use a daily chart to analyze the price movements. Step 2. Identify the trend direction of the stock. You might use a trend line or a moving average to see if the price is moving up, down, or sideways. Step 3. Identify the support and resistance levels of the stock. You might use a horizontal line or a moving average to see where the price tends to bounce or break. Step 4. Identify the trading signals and opportunities of the stock. Use a candlestick pattern or an indicator to see if the price is showing signs of reversal or continuation of the trend. Step 5. Plan your entry and exit points for your trade. Use a stop-loss order to protect your capital in case the price goes against you, and a take-profit order to lock in your profits when the price reaches your target. Step 6. Execute your trade and monitor your performance. Use a trading platform or a broker to place your order and track your results. My personal preference is eToro, a broker that is super user-friendly, has low fees, fast withdrawals, and many more features. It also has the advantage of copy trading, where you can copy any other trader for free and track his portfolio and every action he takes. Before you copy him, you can also check his performance over the past years. I'll leave a link in the description for a free registration. These are some basic steps you can follow to do technical analysis and make trading decisions. Of course, you can modify and adapt them to your own preferences and needs. The key is to be consistent and disciplined and to follow your trading plan and rules. Before we wrap up the video and move to the next one about fundamental analysis, let's look at some real trade examples that show how technical analysis can help us make profitable decisions. We'll use some of the tools and indicators we learned in this video, such as trend lines, moving averages, candlestick patterns, volume, and RSI. Let's open the trading view charts and check an example of Tesla with a breakout buy trade. In this example, we'll see how we could have bought a breakout on Tesla, one of the most popular electric car companies. A breakout is when the price moves above a resistance level, indicating a strong bullish momentum. Before a breakout happens, the stock generally bounces between a range. For many days, it can't break the range to either direction, neither up nor down. Now we will draw a support and a resistance line. The support line is at the bottom of the range, and the resistance line is at the top of the range. To make sure our support and resistance lines are valid, we need at least 3 bounces on each line. The more bounces, the better. We need to see the price having trouble breaking above or below a certain point and changing direction. These points will help us connect our support and resistance lines. Let's look at an example of Tesla, which was ranging between February 2014 and March 2017. It was not trending, but moving sideways. Here is our first point where the price failed to go lower than around $12.73. Here is another one at the same level where the price bounced back up. Here is the third point, and here is a false breakdown. A false breakout or breakdown is when the price briefly moves above or below the range, but then returns to it. This is often done by big investors to take profits and close their positions. We have to be careful of these scenarios, because we might think that a breakout or breakdown is happening and open a trade in that direction, only to lose money when our stop loss is hit. In this case, we can wait for the price to come back to the line it broke and then resume its original direction. Or we can also check the volume. If the volume spikes during the breakout or breakdown, it could be a sign that it is valid. Moving on, here is another point where the price bounced off the support line, and here is a fifth one. On the other side of the chart, we have our resistance line. Here is the first point where the price bounced off around $17.69. Here is a second one at the same level, and then a third one here, a fourth one here, a fifth one, and a sixth one that led to a breakout after about a month. You can see that I drew 2 resistance lines. That's because the support and resistance lines don't have to be exactly at the price. They can be around it. Think of it as an area. So I can also draw a support and resistance area that shows the same thing and makes it easier to see. Let's see how the support and resistance areas look like. Now that we have our support and resistance areas ready, we can trade. The price breaks out from the 1819 level and goes up. The RSI is also above 70, showing bullish momentum. After the resistance line breaks, the price retraces back to the old resistance line, which now acts as a support line. This could be a confirmation to go long, meaning open a buy position. We also set our stop loss between the old resistance area. So if it was a false breakout and the price went back to the range, we wouldn't lose too much money. I set a stop loss of around 10%, and I set a take profit target twice as much as my stop loss, so 20%. This is called a 2-to-1 take profit ratio. Another way to set a take profit target is to look back in time and find previous areas where the price had difficulty making new highs or lows. We didn't have any for Tesla because it was making new all-time highs. So in this scenario, a 2-to-1 risk to reward ratio is a good start. Another way to make more profits is to trail our stop loss when the first target is hit. For example, when we hit our target of 20%, we could move our stop loss to break even, meaning our initial entry. This way, we have no risk from now on. But in this specific trade, the price retraced and hit the stop loss, so we couldn't go for more profits. The choice is yours, and it depends on your risk appetite and strategy. We can also use moving averages to confirm the direction of the trend. We can see that the price was above the 20-day and the 50-day moving averages, which acted as support levels after the breakout. Let's see one more example that we are shorting Nasdaq after breaking down. In November 2021, Nasdaq entered a range after a big uptrend and stayed there until January 2022. You can see the range between the support area of 15,6700 and the resistance area of 16,400. After that, it attempted to break down from the support area, but bounced back up. 3 days later, it broke down with a large red candlestick with strong momentum. The 20-day and 50-day moving averages were also sloping down, so we had confirmations to go short. We sold the index of Nasdaq at around 15,500 with a stop loss of 4%, so we set the stop at around 16,120. But this time, we set the take profit at 6.45%, around 14,500. So now you ask, why do we do that? Because if you look to your left, you can see a previous point where the price bounced off, so it could bounce off again and act as a support level. We could trail our stop loss to break even after we hit the 14,500 level and wait to see if it could go lower. Now, we had no risk while our stop loss was at the price we sold the index. The worst scenario was to make no profit or lose no money. We could also trail our stop loss above the 50-day moving average every time we hit a target. Later on, after it hit the first target, it reached the second target as well at 14,000, which was also a support level. We trailed our stop loss again, and eventually we got stopped out at around 14,550. This gave us a profit of about 6.5%, which was again more than 1.6 to 1, risk to reward ratio. These are just some real trade examples that demonstrate how technical analysis can help us make profitable decisions. And, of course, these examples are not guaranteed to work every time, and there are many other factors that can affect the price movements. We should always do our own research, test our strategies, and manage our risk. And that's the end for part 1 of our market analysis series. I hope you found it helpful and easy to follow. If you did, show us some love by hitting that like button and subscribing for more awesome content. I would love to hear from you, so please leave a comment below with your questions and suggestions for future videos. In part 2, we'll talk about fundamental analysis, another powerful tool for understanding the stock market. We'll learn how to check a company's financial health and find stocks that are worth investing in. Trust me, you won't want to miss it. Thanks for watching and happy trading.